All right, future CAs, welcome. Today we're tackling Accounting Standard 24, Discontinuing Operations. And I know what you're thinking. Oh, this one's easy, right? But let me tell you, this standard is a classic ICAI minefield. Seriously, it's where so many marks just disappear on what feels like a simple idea. Well, that's going to stop today. By the end of this, you're not just going to understand AS24, you're going to see the traps a mile away. So let's get right into it.
So let's jump right in with a question that could be ripped straight from your exam paper. Picture this. A company decides to shut down one of its factories. Why? To boost efficiency? Cut some costs? Makes sense, right? So the big question is this a discontinuing operation under AS24? Now, be honest. Your gut is probably screaming, yes, of course it is. They're discontinuing it. And you know what? That's exactly where the trap is laid. That's the mistake they want you to make.
Because the answer 9 times out of 10 is a big, fat no. And this is IKI's favorite trick, for real. It's how they separate the students who really know the standard from those who are just going by common sense. Here's the key takeaway. Just because something is being shut down doesn't automatically make it a discontinuing operation. And AS24 gives us the exact tool, the precise framework to get this right every single time. And that's what we're going to master right now.
So how do we cut through all this confusion? Well, it's actually pretty simple. We have what I call the 3-point discontinuation test. I want you to think of this as your secret weapon. It's a non-negotiable checklist. You see a discontinuing operations question, you pull out this test every single time. No exceptions.
All right, here they are, the 3 pillars of AS24. Number 1, is there a single coordinated plan? Number 2, is it a separate major line of business or a major geographical area? And number 3, can you actually distinguish it operationally and financially? Now listen up, because this is the most important rule here. This is not a buffet where you can pick and choose what you like. It's an all or nothing deal. You have to meet all 3 conditions. Not 1, not 2, but all 3. If even 1 is missing, it's not a discontinuing operation. Got it? Okay, let's dive into each one.
First up, step 1. There has to be a single plan. What does that even mean? It means the company has a real strategy. It's not just a random decision one Tuesday to sell something. No, there's a clear, thought-out plan to get rid of this part of the business. They could sell it in one big chunk, sell it off piece by piece, or even just abandon it. But whatever they do, it has to be part of one single plan. It's all about intent, a coordinated effort.
Okay, on to step 2. This is what I call the significance test. Basically, the part of the business they're getting rid of has to be, well, a big deal. It can't be some tiny, insignificant operation. It has to be a separate major line of business or a major geographical area. A little pro tip for you, think back to AS17, segment reporting. If it's big enough to be a reportable segment there, it's almost definitely going to pass this test. But keep in mind, it doesn't have to be a whole segment to be considered major.
And these examples make it super clear. Look at the restaurant chain. They sell one restaurant out of a huge chain. It's only 5% of their revenue. Is that a major strategic shift? Nah, that's just business as usual. But now look at the airline example. They're selling their entire airline division, which makes up 25% of their total revenue. Now that is a massive deal. It's a fundamental change to what the company is. See the difference? One's a little tweak, the other one is a complete overhaul.
Okay, but what happens if a company only has one segment? You might think AS24 doesn't apply then, right? Wrong. It absolutely can. In a case like that, you look at major product lines. So if a company gets rid of a product, like this product Y, that was a huge contributor to its profits, yep, that can still qualify. The key thing to remember is that major is always relative. It depends on the specific company we're looking at.
Okay, everybody, I need you to really focus on this slide. This is your shield. This is what's going to protect you from the most common traps ICAI sets. These are things that sound like discontinuing operations, but they are not. Things like slowly phasing out a product line, or shifting production from one factory to another, or closing a facility just to save some money. These are normal, day-to-day business decisions. They are not discontinuing operations under AS24. Seriously, burn this list into your brain. It will save you marks, I guarantee it. And that brings us to our final hurdle, step 3. This is the practical test for us accountants. The question is simple. Can you cleanly separate its financials? Can you point to its specific assets, its liabilities, its revenues, and most of its operating expenses? If everything is all tangled up and you can't neatly carve out the financials for just that component, well, it fails the test. It's that simple.
If you can't separate the numbers, it's not a discontinuing operation.
Okay, deep breath. We've gone through our 3-point test, and ding, 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 we have a discontinuing operation. Awesome. But now comes the next critical question. When? When do we actually start disclosing this stuff in the financial statements? This is all about finding the initial disclosure event. And let me tell you, this is a favorite for MCQs. Get this date wrong and you lose easy marks. So let's make sure we nail it.
Look at this slide. See those words in all caps? Whichever occurs earlier, these might be the 3 most important words in this entire standard. I'm going to say it again, whichever occurs earlier. ICAI absolutely loves to give you a bunch of different dates in a problem just to see if you remember this rule. Your job is to find the 2 possible trigger events, look at their dates, and pick the one that happened first. Always the earlier one.
So what are these 2 potential triggers? Let's break it down. The first one is super simple. The company signs a binding sale agreement. Done. That's a date. The second trigger is a little more complex. It has 2 parts. The board of directors has to approve a detailed plan, and they have to publicly announce it. The trigger date is when the second of those 2 things happens. So you find the date for trigger 1, you find the date for trigger 2, and what do? You pick whichever's earlier. That's your initial disclosure event.
Okay, so we know what qualifies as a discontinuing operation, and we know when we have to start reporting it. Now for the really practical part. Where does all this information go? This is so important for those big descriptive questions. It's all about knowing the difference between what goes on the face of the P&L and what goes in the notes to accounts.
Right, so once that trigger date hits, you've got a laundry list of things you need to disclose. This slide is basically your checklist. You've got to describe what you're discontinuing, what segment it was in, tell everyone the trigger date, give a timeline for when it'll all be done, and then you get into the numbers. The value of the assets and liabilities you're getting rid of, and of course, the revenue, expenses, profit or loss, and the cash flows from that operation for the period. It's a full picture.
Okay, stop what you're doing. This slide right here is pure exam gold. I'm serious. Take a screenshot, write this down, just remember this. This is what ICAI tests. On the face of the P&L, you only show 2 numbers, 2 line items. First, the pre-tax profit or loss from its normal day-to-day activities. Second, the pre-tax gain or loss you made from actually selling the assets. That's it. Everything else from that big checklist we just saw, the description, the carrying amounts, the cash flow breakdown, all of that gets tucked away neatly in the notes to accounts. This distinction is where the marks are. But wait, we're not done yet. You can't just disclose this once and forget about it. This isn't a one-and-done kind of thing. IAS 24 says you have to keep reporting on it in every single financial statement until that disposal is totally, completely finished. So let's look at what that means.
So you have some ongoing duties. First, if anything big changes, like the amount of cash you expect to get or the timing, you have to update your disclosures. Second, and this is huge for presentation questions, you have to restate the previous year's numbers. You have to separate them into continuing and discontinuing so people can make a fair comparison. Third, what if the company changes its mind and abandons the plan? Well, you have to disclose that, and why. And finally, if you're doing interim reports, you've got to follow the rules of AS 25.
All right, that's enough theory for now. You know the best way to really get a handle on a standard, right? It's to apply it. So let's do exactly that. Let's put on our examiner hats and work through a classic ICAI-style problem, using the tools we've just learned.
So here's the case. We've got Rohini Limited. They're getting out of the passenger car business. But look at the details. They're going to phase it out over 5 years, just cutting production by 20% each year. And crucially, it says there's no specific plan for selling off the assets. So, what do you think? Is this a discontinuing operation? Let's run it through our 3-point test.
Okay, let's break it down. Step 1. Do we have a single, coordinated plan for disposal? The answer is no. And the keywords that give it away are gradual phasing out. Remember that? That was right on our exam trap slide. A slow wind down is not the same as a concrete plan to sell or abandon, so it fails the very first test. We don't even have to look at steps 2 and 3. The verdict is in. This is not a discontinuing operation.
But of course, the examiner loves a good twist. So now, what if the facts changed just a little bit? What if the board passed a resolution to sell the assets in a phased but time-bound manner? It's just a few words. Does that change anything?
You bet it does. It changes everything. That phrase time-bound, that's the magic ingredient. That one little phrase turns a vague plan into a concrete, single plan for disposal. It shows clear intent. Suddenly it passes step 1 with flying colors, and assuming it's a major and distinguishable part of the business, boom, AS 24 is now fully in play. It just goes to show you, In these exams, every single word counts.
All right, before we wrap up, let me leave you with one final thought, something to really connect the dots. We've established that discontinuing a major operation is a big deal, right? It needs tons of disclosure. But think about this. Does classifying something as discontinuing automatically cast doubt on the company's ability to be a going concern? Or could it actually be a sign of strength? A company cutting off a weak part of the business to become healthier overall? What is the real link between AS24 and that fundamental going concern concept? Chew on that. That's the kind of critical thinking that's going to make you stand out.